Hello, my name is Melissa Golding, and I'm the press officer for the Group of 30. I'd like to welcome all of you to today's live press conference and webinar launch of the G30's new research report, the Federal Reserve Monetary Policy Framework Review, a comprehensive approach to improve robustness. We will begin the webinar with opening remarks from the chair of the Group of 30's Working Group on the 2025 Federal Reserve Monetary Policy Framework Review, Mr. William C. Dudley. Mr. Dudley will be followed by Project Advisor Carolyn A. Wilkins. Please note that this report and presentation represent the views and recommendations of the Group of 30's Working Group on the 2025 Federal Reserve Monetary Policy Framework Review, and not the Group of 30 as a whole. While the report reflects broad agreement among the working group's participants, this does not imply agreement on every specific observation or nuance. Working group members and the project advisor participated in their personal capacities, and their participation does not imply the support or agreement of their respective public or private institutions. Today's speakers are likewise participating solely in their personal capacities. I'd now like to introduce William C. Dudley, chair of the G30 Working Group on the 2025 Federal Reserve Monetary Policy Framework Review. Mr. Dudley?
Thank you, Melissa. It's a great pleasure to be here today. Before I begin with my remarks, I want to just a few thank yous are in order. First of all, I want to thank Carolyn Wilkins, project advisor on this project, provided valuable advice, writing, exhibits. Couldn't have done it without her, so I want to thank her. And second, I want to thank the other working group members. We had a great working group: Mohammed El Arian, Jacob Frankel, Mervyn King, Guillermo Ortiz, Masaki Shirakawa, Yi Gang. As you can see, central bankers from around the world. And I think that their contributions to the report was considerable, and it helped us give a framework that reflects international experience, not just focused on the U.S. So, and I also want to finally thank the Group of 30 Secretariat. Stuart McIntosh is the executive director, Melissa Golding, who is running the show today, and Desiree Makuda and Maria Cueto. We couldn't have done it without the support of the Group of 30 Secretariat, so thank you. So let's turn to slide one, and I'll talk a little bit about the purpose of the report. The purpose of the report was to evaluate the existing framework, which was introduced in 2020, in light of the lessons learned in the aftermath of the COVID pandemic. As we'll see, the 2020 framework wasn't well suited for the environment that we actually experienced, and that's really creating some of the motivations behind this report. The report is going to focus on three dimensions. One, the Fed's objectives for employment and inflation, the Fed's dual mandate. Second, the tools and operations that the Fed uses to achieve those two objectives, and the communication strategies that the Fed deploys to communicate about the Fed's reaction function, about the Fed's economic forecast, that drive how markets respond and anticipate Fed actions. And finally, of course, the report's goal is to make some substantive recommendations that would improve the framework and contribute to the 2025 review. I think in this report, we're trying to have recommendations that are not just substantive, but also actionable. So we think that the suggestions in the report are things that the Federal Reserve actually could and should do. Next slide, please. So what are the key features of the 2020 monetary policy framework? So in 2020, the Fed introduced their flexible average inflation targeting framework, which introduced several important changes compared to their prior strategy. The changes were made because the Federal Reserve was concerned about inflation being too low, inflation expectations being unanchored to the downside. And they were worried that if the recession hit, the Fed would be back at the zero lower bound for interest rates, and monetary policy might have difficulty providing sufficient stimulus to get the Federal Reserve out of that situation. So the Federal Reserve made two really substantive changes to their monetary policy framework in 2022. The first substantive change is they changed their employment objective to minimize shortfalls from maximum employment. Before, it was all about deviations of employment on both sides, up or down, but now it's minimizing shortfalls from the maximum level of employment. That meant a one-sided test for employment. That meant running the economy hot until you actually saw signs of inflation. And the second substantial change was in terms of their inflation objective. Prior to 2020, the Fed was trying to target 2% inflation always. If you missed on the upside, you tried to go back to 2%. If you missed on the downside, you tried to go back to 2%. But the Fed was concerned that having a long period of inflation running below 2%, this was causing inflation expectations to be a bit on the softer side. And so they introduced what's called a makeup strategy. The makeup strategy is a strategy in which misses to the downside of inflation would be offset by misses to the upside, but not vice versa. So if inflation was running below the Fed's 2% objective, they would try to allow inflation to run above the 2% objective for a time. But if inflation was running above the 2% objective, they would not try to make up for that. They would just try to get inflation back down to 2%. There are a lot of things that 2020 framework did not do. So there's still some gaps, I think, in the monetary policy framework. There was no substantive discussion of quantitative easing or quantitative tightening. There were no significant changes in communications. The Fed's summary of economic projection was modified ever so slightly by introducing some fan charts in the back of the summary of economic projections to show uncertainty, but otherwise communication policy was unchanged. The Fed kept its short-term interest rate target as the federal funds rate, despite the fact that the federal funds rate market was becoming increasingly idiosyncratic. And there was no formal consideration of the linkage between monetary policy and bank regulation and financial stability, something that I think became an important shortcoming when we encountered the regional banking turmoil in 2023. Next slide, please. So what were the unintended consequences of this new monetary policy framework? Well, the simple answer was that the Fed was late. The Fed was late because of the framework. It stressed the idea of getting to full employment and pushing inflation up to 2%. The Fed was also late because the way they operationalized the framework is they set a bunch of conditions that the Fed couldn't actually raise interest rates until they had gotten to 2% inflation. Inflation was expected to go above 2% in the future, and they were at what they judged the maximum level of employment. So what this meant that is in March of 2022, before the Fed began to tighten, monetary policy was extremely accommodative. The economy was growing very, very rapidly. The unemployment rate was extremely low, and the economy was overheating. Inflation was over 5%. So this made the Federal Reserve, the Federal Reserve was very, very slow to react to what was happening in the economy at that time. Next slide, please. You can see how late the Federal Reserve was during this period by comparing what the Fed actually did, the federal funds rates, the green line, to what the Fed's own monetary policy rules said the Fed should do in terms of the timing of liftoff. If you look at the four monetary policy rules that the Federal Reserve has highlighted in their monetary policy reports to the president, to Congress, what this shows is that the rules suggested that the Fed should have begun raising rates about a year before they actually did so. Next slide, please. The second unintended consequence was with respect to financial instability risk. When the Federal Reserve was engaged in massive quantitative easing, that inflated bank deposits and assets holdings significantly. You can see in this chart, there was a very significant rise in commercial bank deposits from the beginning of QE to the end of QE over that several year period. When the Fed buys securities, the people that receive the cash for the securities, eventually that cash makes it back into the banking system. So the Fed's asset purchases do cause the bank balance sheets to grow very rapidly. And that wouldn't be a problem if the banks had just taken those deposits and invested in short-term fixed income assets. But some regional banks, Silicon Valley Bank in particular, First Republic Bank in particular, use those monies to buy long-term fixed rate assets. And so when the Fed ultimately raised rates very significantly beginning in 2022, this led to a very large increase in short-term funding costs and pushed the value of the securities that these banks had bought underwater. So the Fed's QE program did contribute indirectly to the banking problems that we had in 2023. Next slide, please. So the second unintended consequence that I think is really significant is that the cost of the QE and QT program turned out to be much higher than the Federal Reserve anticipated. The Federal Reserve never expected that they were going to have to push short-term interest rates up over 5%. And as they did that, that caused the cost of the Fed's funding, the interest rate the Fed pays on reserves, to climb well above the earnings that the Fed makes on its long-term treasuries and mortgage-backed securities holdings. So here's a chart that looks at what the Fed projected net income was likely to be under a variety of interest rate scenarios in 2021. This report was published in the spring of 2022. And what it shows you is baseline forecast. The Fed's earnings dip, but they still make money. The optimistic scenario, where interest rates are 100 basis points lower than the baseline, the Fed makes more money. And in the pessimistic scenario, the baseline 100 basis points higher than the Fed's interest rate forecast, the Fed loses a very small amount of money for about a year or so, and moves very, very rapidly into positive territory. Well, unfortunately, that's not what happened. Interest rates rose several hundred basis points above what the Fed expected. And the Federal Reserve, as a consequence of that, has incurred very large losses. If you look at the H41, which is the weekly Fed balance sheet, the total losses that the Fed has booked to date are almost $230 billion of losses. And in terms of opportunity costs, if the Fed hadn't done QE, how much money would they have earned relative to these losses? Total losses from the QE QT program are going to turn out to be about somewhere in the neighborhood between $500 billion and $1 trillion. So QE QT turned out to be very, very expensive. The second issue with QT is it really wasn't integrated in terms of the Fed's regulatory policies. So when the Fed's engaging in QE, it's flooding the banking system with deposits, it's building up bank balance sheets. And as bank balance sheets expand, that makes the supplemental leverage ratio, which is a simple leverage ratio of banks' capital to total assets, more binding. So on one hand, the Fed is trying to provide monetary policy stimulus by QE, but on the other hand, the provision of that monetary policy stimulus is actually making the supplemental leverage ratio more binding. So the two things are working at cross purposes, not a good outcome. Next slide, please. Second, another issue of the Fed's 2020 monetary policy framework review and how that was operationalized is the Fed did not address some significant communication gaps that existed in the 2020 framework and became very important, I think, subsequently. For example, the flexible average inflation targeting guidance was very unspecific about how do you make up those inflation shortfalls by overshooting? How long should you take to get back to a 2% inflation on average? How high an overshoot are you willing to tolerate? So the Federal Reserve's guidance on a flexible average inflation targeting was quite incomplete. The second problem, I think, in terms of communications gap is that the summary of economic projections only had one modal forecast that people were focused on. It didn't include alternate scenarios. So people were very much focused on what the Fed thought was the modal outlook and not focused very much on what the Fed would do if the outlook evolved in a different way than the Federal Reserve expected. Also, the summary of economic projections focused people very much on the so-called dot plot, the interest rate projections of the Federal Open Market Committee participants. And so the dot plot basically took a lot of attention away from, I think, much more important questions. It was all about, well, how many rate cuts does the median FOMC participant expect to occur in 2022, 2023, et cetera. And finally, the Fed communications didn't really provide intensive guidance about how the Fed would manage the trade-offs between inflation and employment. If inflation was too high, employment was too low, how would the Fed manage that conflict? And so those are gaps that we think should be filled going forward. Next slide, please. So I'm going to turn it over now to Carolyn Wilkins, and she'll talk about the 6 major recommendations that the group of 30 has made.
Thank
Carolyn?
you. Thank you, Bill. As Bill just went through, clearly the Federal Reserve responded forcefully to what were extraordinary challenges of the pandemic. And I think we need to acknowledge that they were doing this in a period of extraordinary uncertainty. Now, with hindsight, there are many lessons to learn, and many are shared by central banks around the world. And I think for this reason, it's difficult to be precise about how much of the run-up in U.S. inflation can be traced to the changes to the framework itself and those that are attributed to other reasons. When we looked at it from the Group of 30 point of view, we decided to have a focus in terms of our recommendations that are forward-looking. And by that, these are recommendations that aim to strengthen the framework's robustness, its transparency, as well as its accountability. And when I use the term robustness, I mean a framework that performs reliably across a wide range of economic conditions and that can adapt as circumstances evolve. Perhaps not surprisingly, the first recommendation that we have is to move back to a clear symmetric inflation objective. The flexible average inflation targeting regime was at the time a thoughtful response to persistently low inflation and worries about the zero lower bound, but it turned out to be quite ill-suited to a period of upward shocks to inflation like the one that we saw. And it also introduced ambiguity among many dimensions, and along many dimensions, including what the target actually was over what time frame. And I think that a symmetric target would restore clarity about those objectives. It would also help to anchor expectations while supporting timely actions in the face of inflationary and disinflationary shocks. The second recommendation is with respect to the employment objective. Remember that Bill talked about the current framework focusing on minimizing shortfalls from maximum employment, which in our view reduce the flexibility to act preemptively. So we recommend returning to an employment objective defined as the maximum level of employment consistent with price stability. What this framing would do was restore a more balanced approach between the Fed's dual mandates. You've got to acknowledge that excessively tight labor markets can pose inflation risks even before price pressures are fully visible. It also would enable the Fed to weigh employment and inflation objectives simultaneously and symmetrically, which is particularly important when they're in conflict or there's a tension. In that regard, there can be some work done to clarify how trade-offs will be managed. There's obviously going to be times when inflation and employment goals are in tension. Of course, the current context is a case in point. The Fed needs to retain the flexibility to respond in real time with the understanding that the inflation-employment trade-off can shift depending on the macroeconomic context. But what really matters is that the Fed explains how it's weighing those trade-offs, especially under uncertainty, so the public and markets can interpret decisions with confidence. The next objective with respect to a QE-QT framework is pretty in-depth, so I'm going to skip this for a second and come back to it in the next slide. In that regard, we thought that there should also be scenario-based staff forecasts. And Bill talked a lot about the communications challenges. Right now, as many of you know, the Summary of Economic Projections is a valuable communications tool, but there are some limitations in its scope. As Bill said, it focuses on medians and baseline paths with little information about alternative scenarios or outcomes under which policy might change. And I think this is a particular weakness during periods of high uncertainty when economic dynamics are nonlinear and hard to forecast. The G30 recommendations are that the Fed regularly publish a scenario-based staff forecast alongside the SEP. These could include plausible alternative paths for the economy under different scenarios like stronger than expected disinflation or renewed supply shocks. and it could include the associated implications for policy. What this would do is help markets better understand how the Fed might respond under different conditions. This would help improve transparency and credibility. Some other central banks are doing this, or they're starting to do this, and so there are some models and joint work that could happen to make this a reality. The last recommendation is to create a forward guidance playbook. For a lot of central banks, including the Fed, forward guidance has become an essential part of the toolkit, and that's particularly true when interest rates are near the effective lower bound. In recent years, the Fed has adapted its guidance thoughtfully in evolving conditions, but unfortunately, the public's understanding of its intent has sometimes been limited. What the G30 recommends is developing a forward guidance playbook that's a transparent approach to clarify when and how different forms of guidance may be used. You can think about distinguishing between calendar-based guidance or outcome-based guidance. Each of these types of guidance has its place, but a structured framework would help explain how the choice reflects the broader policy strategy. So now if we turn back to what we have in mind with respect to our proposed framework for quantitative easing and quantitative tightening, just the context for that is that the asset purchases that we saw in 2020 and 2021 were obviously made under extraordinary uncertainty, and it's clear that internal frameworks were used to guide these decisions. But they weren't publicly articulated in detail, and it wasn't really clear how those frameworks would evolve or decisions would be based on different aspects of the framework over time. At first, the actions were to stabilize markets, and then they were to support the recovery. I don't think this situation is at all unique to the Fed. Central banks more broadly have faced similar challenges in separating asset purchases across different lines of purpose and communicating that. But now that QE is a standard policy instrument, a more structured and transparent framework would support accountability by clarifying the rationale for decisions and how they might change. It would also, for obvious reasons, enhance transparency. So how would this framework look? Well, this is a rough outline of what it could look like, starting with just establishing clear objectives and communication, defining the purpose of each program. Is it about market functioning, a macro stimulus, and trying different ways to explain this in plain language to enhance the understanding of the market and preserve, by doing that, some credibility. The harder part is really developing an evaluation framework of the expected benefits. Conducting and publishing a full cost-benefit analysis before large-scale asset purchases would be very beneficial from an accountability and transparency point of view. Have to admit that that's easier said than done. What this framework should do is go beyond the macroeconomic effects to include potential risks such as financial imbalances of the kind that Bill was talking about, or potential financial risks to the balance sheet. It should also incorporate scenario modeling of balance sheet impacts under different interest rate paths. Crucially, the assessment, or at least parts of it, should be updated dynamically as conditions evolve, so that decisions to extend or scale back or exit QE programs are continuously informed by a transparent reassessment of the benefit and costs. Another aspect that would be beneficial is an exit strategy framework that's flexible but has clearly articulated criteria for tapering or ending QE based on, say, inflation or labor market progress or financial conditions. In this framework, it's pretty important to avoid rigid sequencing unless somehow it's justified. The final thing I would point to is just the rationale for the end game. The Fed has started to talk about this, but there will be a time when it'll be really beneficial to be clearer about its long-term vision for its balance sheet, because there are some important open questions. For example, what is the Fed's target balance sheet in steady state, or how much reserve supply is optimal? What role, if any, are there for mortgage-backed securities? They're very difficult questions, but a well-defined end game would guide future QT decisions. It would reduce ambiguity around asset holdings, and it would support a more predictable policy transmission over time. So just to summarize all that, I think many central banks are reflecting on how better to structure the use of balance sheet tools, and this kind of framework would add value. Back to you, Bill.
Thank you, Carolyn. Chair Powell has indicated that the 2025 framework review will not include evaluation of the Fed's monetary policy tools, or he will not consider changes to the Fed's 2% inflation objective. Starting with the latter, it's pretty obvious. We agree with Powell on the 2% inflation objective. We think that it would be a mistake to change it. If the Fed were to raise the inflation target with the motivation of having higher inflation means higher nominal rates, the more room to cut rates in an economic downturn. That's the rationale for a higher inflation target. I think that this would be quite damaging in terms of one, leading to an anchored inflation expectations. I think it would reduce Fed's credibility. You're basically raising the target because you can't actually achieve your 2% inflation objectives. I think also it's important to recognize that the benefits of a higher inflation target in reducing the risk of being pinned at the zero lower bound do seem to be lower now, because it looks like R-star, the short-term interest rate consistent with a neutral monetary policy, has risen. Currently the federal funds rate is in a range of 4.25% to 4.5%. So the Federal Reserve has quite a bit of room to cut rates without hitting the zero lower bound for interest rates. Now, the Fed has determined that the monetary policy framework review is going to be relatively limited in scope, but that didn't stop us from coming up with a few other proposals that we think that would improve the conduct of monetary policy in the U.S. Three other proposals that we would like to make. Number one, we think the interest rate on reserves should be the main policy rate. Currently, the Federal Reserve targets the federal funds rate. The federal funds market has become increasingly idiosyncratic. Most of the trading in the federal funds market takes place between government-sponsored enterprises, such as the Federal Home Loan Banks and foreign banks. The GSEs are now allowed to earn interest on reserves, so they sell those reserves to foreign banks who can. And that's really what the federal funds market is mostly about at the current time. The second thing is the reason to introduce the IOR is that it is the rate that determines all other short-term rates. The interest on reserves is a rate that really determines where the federal funds rate trades. And so if you rely on the IOR, you're going to have a pretty good sense of where the federal funds rate is going to be. Keeping the federal funds rate as the target introduces also unnecessary complexity in the conduct of monetary policy. For example, the Federal Reserve introduced the reverse repo facility for large asset managers in 2013, not because it was trying to provide some facility for large asset managers to benefit from, but to make sure that there was a floor under the federal funds rate, so the Fed would not violate its federal funds rate target range. You stop targeting the federal funds rate and use the IOR as your main policy rate, you no longer need a reverse repo facility. So this makes the monetary policy quite a bit simpler. Now, some people say you can't do this because the governance of the IOR is by the Board of Governors, while the federal funds rate is determined by the Federal Open Market Committee. But I think this is a trivial problem. Every January, the Board of Governors could meet and say, we are going to accept the recommendation of the Federal Open Market Committee in terms of what IOR we should set. Second proposal that we would make is that we think that the conflict between QE making the supplemental leverage ratio more binding could be easily fixed by exempting reserves from the supplemental leverage ratio. Two reasons to exempt reserves from the supplemental leverage ratio. Number one, they don't have any risk. There's no credit risk. There's no maturity risk. This is cash at the Fed. So having more reserves on a bank balance sheet does not contribute to the bank having more risk. And the second reason, obviously, to take this out of the LAR is you don't want to have monetary policy trying to make to expand bank balance sheets, make monetary policy more stimulative, and that being thwarted by a supplemental leverage ratio, which is becoming more binding. The last proposal is we think that monetary policy decisions should be more closely integrated with decisions on bank supervision and financial stability. The fact is that when the Fed did massive QE, it drove up the amount of bank deposits and bank assets significantly. This did contribute to the 2023 regional banking crisis. I think if monetary policy, bank supervision, and financial stability were more closely integrated, this might not have happened. Also, the supplemental leverage ratio, when it was originally developed following the great financial crisis, I think people would have exempted reserves from the supplemental leverage ratio if they had actually talked to the monetary policy makers. So thinking about the Federal Reserve roles, not just about monetary policy, bank supervision, financial stability separately as verticals, we want the different groups to talk to each other to make sure that actions in one regime don't have unintended consequences for other parts of the Federal Reserve's mandate. So that's our main recommendations and other steps that we would suggest. So in conclusion, let me just say that I do think Chair Powell deserves a lot of kudos for launching systemic framework reviews and for taking the Fed through a very difficult and perilous time during the COVID pandemic and its aftermath. The point of having systematic framework reviews is that the world changes and the financial system and structure of the financial system changes. And as the financial system changes, and structure of the economy changes, you need a monetary policy framework that keeps up with those developments. Now, as it turned out, the 2020 framework, it turned out, was designed for a low inflation world. It was really designed to prevent inflation expectations from falling, to reduce the risk of being pinned at the zero lower bound for interest rates. That was a laudable goal, but that framework turned out to be overly specialized and turned out to be pretty poorly suited to the rapid recovery we saw following the introduction of vaccines in 2021. And the supply shocks that drove up inflation post-COVID. So we think that there need to be changes both to the framework and the monetary policy tools that support that framework, so support the robustness of monetary policy in the future. We hope that the Federal Reserve and others understand that the G30 report is trying to provide a constructive blueprint for the Fed's 2025 reforms. I think these reforms are pretty important because the Federal Reserve is also under a lot of institutional pressure politically at the current time. And how the Fed responds to that, I think, is important. Some people say that the Fed will react to that by keeping their head down and will make minimal changes to the monetary policy framework. I personally think that would be a mistake. The best way to demonstrate why you should be independent is to do the things you need to do to make your monetary policy framework as effective as possible. So I'm hoping that the Federal Reserve is brave and makes the changes that we think would be appropriate to the 2020 monetary policy framework review. So with that, let's turn it back to Melissa and open it up for questions.
Thank you, Mr. Dudley. Our first question is from Mark Zashin at Walmart Investments. Did the Fed during this period spend more time on the employment aspect compared to price stability of their dual mandate?
Well, I think that the answer to that question, do they spend more time on their employment mandate or their inflation mandate, is the framework created an incentive to be patient because you're trying to minimize shortfalls of employment from the maximum level. The Fed basically put themselves in a position where they couldn't raise interest rates until they were convinced that the labor market was really at the maximum sustainable employment. Now, it turned out that turned out to be a mistake, partly because the Federal Reserve made a bad forecast. They, like most central banks around the world, did not anticipate the surge in inflation that we saw as the economy reopened post the COVID pandemic. And I think if the Federal Reserve had understood what the consequences of the reopening of the economy were going to be in terms of inflation, they probably would have behaved quite differently. But the framework and how the framework was implemented, I think it did contribute to making them slow off the mark, because they basically said we can't raise rates until we satisfy these three conditions. And they also had additional conditions. They basically said we can't raise rates until we finish QE, and we can't end QE abruptly. We have to taper QE, and all these things stretched out the timing to terms when the Federal Reserve actually started to raise rates. As we saw in the chart in our presentation, there was about a year between when the monetary policy rules that the Federal Reserve uses that the Fed should lift off and when the Federal Reserve actually lifted off. And so I think that's probably where the Federal Reserve could have done a little bit better. But the mistakes that the Federal Reserve made were, primarily driven by forecasts, and those forecast errors were, that happened to central banks broadly around the world. If you look at the timing of takeoff, I think the Brazil central bank was sort of first, and then most of the major economies, central banks took off roughly around the same time. So that tells you that it isn't all about just the framework.
Thank you. Our next question is from Loretta Mester, Professor of Finance at the University of Pennsylvania. How would the Fed's monetary policy decisions in 2021, 2022 have been different if they were following your framework, the changes that you have recommended?
Well, we'll never know. But I would speculate that if the Federal Reserve had put more weight on the inflation side of their mandate, which they would have done if they weren't following a flexible average inflation targeting regime, that they wouldn't have done if they had a more symmetric employment objective. Presumably, the Federal Reserve would have started to tighten monetary policy sooner. In my view, in early 2021, the downside risks to the economy fell considerably for two reasons. One, we had vaccines that seemed likely to work in terms of addressing the COVID pandemic. And two, a massive fiscal package was passed by the Biden administration, $1.9 trillion fiscal package. So in my mind, the combination of the pandemic abating, the large fiscal package meant that the economy was going to do fine. And so at that time, it was probably the time to sort of dial back monetary policy accommodation. Carolyn, any thoughts on this?
Yeah, that's a great question. And you can answer it empirically, or you can try to. And one of the Federal Reserves just came out with a paper maybe a month ago that tried to do that. And their conclusion, I'm sure it's full of caveats, was that in not very much of the inflation overshoot was due to the framework rather than just other kinds of misses, including in the forecast. So in my mind, I'm not sure how much that changes the validity of our recommendations, which are really just trying to point out, especially on the restoring symmetry part, that in a world that's not characterized by the zero lower bound concerns, but also concerns about upward shocks to inflation and increasing scenarios with trade-offs, that we really need to have a framework that's robust to those kinds of circumstances and leads the central bank to be able, within their framework, to justify being preemptive, appropriate to any particular situation.
I also think that by using the framework they used at the time, by being late, that meant the Federal Reserve was going to have to tighten monetary policy more aggressively. It was the fastest tightening of monetary policy since the 1980s. That obviously imposed a lot of stress on the banking system. And there was a risk that by being late, that inflation expectations would become unanchored. That didn't happen, thankfully, but the Fed was taking more risk in that dimension. So I think the Fed could have avoided some of those risks if it had gone a little bit earlier.
Thank you. Our next question is from Haruhiko Kuroda, former governor of the Bank of Japan. How might inflation implications of the recent U.S. tariffs or threatened future tariffs influence the coming framework review process?
Well, hopefully it won't to any meaningful degree, because the framework is something that should be, suited for all seasons, regardless of how the economy actually evolves. I think the biggest issue about the framework is the attacks of the President Trump on the Fed's independence, and the question is how will the Fed react to those attacks? Will it hunker down and sort of say nothing to see here? The framework was fine, everything was great, or will the Fed be more, I think, forthright and say, look, there are things that we can do better, and here's how we're going to do them. I think the latter approach is a much preferable approach for two reasons. One, it basically enhances the credibility of the Fed for them to stand up and say there are some things that we can do better. And two, it would result in a better monetary policy framework. So that would improve the conduct of monetary policy going forward. Carolyn, thoughts?
I agree with all that, and I think the recommendations, to the extent that they're aiming at increasing the ability to be accountable to something that's clear, as well as being transparent about the means through which that's being done, those are things that, whether you're the Fed or you're any other central bank, are going to underpin independence and increase its longevity, because clearly in the US, it's become a worry if you read the news. But certainly the nature of the lessons that are being learned in other jurisdictions lead to the same kinds of recommendations about doing whatever can be done to improve accountability and transparency.
Thank you. Our next question is from Paul Sheard, author of The Power of Money. Should the Fed revisit or explain better its ample reserves framework?
So as a former system open account manager, I have a lot of thoughts about the switch from a scarce reserves regime to the plentiful regime we have today. Just as way of background, when the TARP legislation was passed in the fall of 2008, it gave the Federal Reserve the authority to pay interest on reserves immediately. And that turned out to be very, very important, because it allowed the Fed to basically have a large balance sheet, but maintain control of monetary policy. When in the prior regime, if the Fed added more reserves to the banking system, the federal funds rate would collapse to zero. And so as we went through the great financial crisis, we were always trying to figure out how can we provide more liquidity support to the economy, but without causing the federal funds rate to crash. And so this limited the scope of the Fed's interventions to support monetary market function in 2007 and 2008. The interest rate on reserves regime sort of breaks that link. You can conduct monetary policy with the interest rate you charge on reserves, and you can then address market function issues through your balance sheet. It also simplifies the execution of monetary policy. In the old regime, when you were targeting, when you were trying to manage reserves to keep the federal funds rate right at its target, since reserves were non-interest earning, banks didn't want the reserves, so they're always trying to trade reserves to someone else that need them to satisfy their reserve requirements. And there was a lot of day-to-day interventions that had to occur in the money markets to keep the supply of reserves at a level consistent with the federal funds target. Now, if the reserves in the banking system go up or down, even by tens of billions of dollars, there's no effect on the level of short-term interest rates. So you've sort of cut that linkage. So I think the interest on reserves regime is a much better one. I think it makes monetary policy execution more efficient. I think it also allows you to pursue market interventions to support financial stability without losing control of monetary policy.
Our next question is from Cesar Botel at the National Bank of Romania. Recommending that IOR should be the main policy instrument, do you assume that abundant liquidity will persist indefinitely? How about Claudio Borio at the BIS make a recommendation for getting up from the floor? Borio's recommendation: since the great financial crisis, a growing number of central banks have adopted abundant reserve systems, floors, to set the interest rate. However, there are good grounds to return to scarce reserve systems, corridors.
So in the United States, frankly, it'd be very difficult to return to a scarce reserve system for a whole host of reasons. One, the Federal Reserve has a really big balance sheet. Two, banks hold these reserves to satisfy liquidity requirements like the liquidity coverage ratio, to have liquidity to satisfy the living will requirements for if the bank were to ultimately fail sometime in the future. So I think it'd be the transition path back to a scarce reserves regime would be extraordinarily difficult. That said, you could make the case that if you really believe that the scarce reserves regime was a better regime, then that would still, you can still make the case for making that transition. But I don't see it as a better regime. I think that the current regime gives you the Fed more flexibility. Now, that said, the Fed Reserve shouldn't have more reserves in the system than what it needs. And that's why quantitative tightening is occurring today. The Federal Reserve is trying to take down the level of reserves from abundant to ample. Ample is the level of reserves that's sufficient so that fluctuations in the reserve balances don't cause a shortage in reserves relative to what banks desire. Today, there are more reserves than banks need. The Federal Reserve wants to have a margin for error. And so QT is the process of sort of bringing down the amount of reserves in the system, but not so close to the level of actual desired reserves that you have the kind of spike in short-term interest rates that we saw in September 2019 when reserves actually became scarce. So I think the Fed's policy with respect to QT and what they're shooting for is appropriate, and I think I don't have any recommendations for the Fed in terms of moving back to a scarce reserves regimes, except not to do that. Carolyn, any thoughts on this?
Yeah, I would just add that when it comes to these kinds of regimes, there's not a one-size-fits-all solution, because it very much depends on the structure of financial markets and of the financial institutions that operate within those markets, how much you can rely on them doing some of the heavy lifting in terms of interacting with themselves as opposed to with the central bank. And so for a country, for example, like Canada, that operated within a corridor system for a very long time, a transition back to that or something that's closer to a much smaller balance sheet is perhaps more feasible than, say, for the United States and the Federal Reserve.
Thank you. Our next question is, what is the future for QE? Will the Fed use it again, or was this an expensive experiment?
I'm going to give that to Carolyn.
I don't think you're going to have a central bank that's going to throw out a tool from their toolbox that may come in handy in the future. What we were hoping to achieve from our request for a framework that would be around QE, in particular the cost-benefit analysis, is really the test about whether it's the expected benefits are going to exceed the expected costs and the related risks. For ideally, those expected benefits, net benefits, would be put alongside other types of policies that could be brought to bear in similar situations. For example, different kinds of fiscal interventions. Especially in the context where some types of central bank interventions appear to be blurring the line between fiscal policy and monetary policy. Of course, in the United States, that's very difficult to achieve. You want to aim for to figure out what's the best tool for the job given the problem we have across all the different policy levers there.
Thank you. Our next question is from Matthias Ajanzenberg. He's an economist at P&S Associates. How is uncertainty, such as the one measured by the policy uncertainty indexes, incorporated in Fed models, if they are?
I would say the Fed definitely thinks about uncertainty in terms of their modeling. I'll just give you an example. One reason why the 2020 framework was introduced was because the Fed made some estimates about what was the probability of being pinned at the zero lower bound for interest rates. And in 2019, they concluded that that risk had gone up significantly. And so that provided some of the motivation. The Fed is always thinking about, the fact that the central forecast is almost certainly not going to be realized. And they do think a lot about, the different outcomes that are possible. And this is when Chair Powell talks about risk management, that's really what he's talking about. We need to have a monetary policy in place that not only is best for the most likely scenario, but is well suited for a range of possible outcomes. And that in the current environment, that's what the Fed's wrestling with today. Higher tariffs are going to drive up prices, and they're also going to drive down economic growth. And so the Federal Reserve is, working really hard to think about what are the risks around tariffs on both the employment dimension and inflation dimension, and thinking about how this is going to, affect the outlook. One key issue currently is inflation expectations. The Federal Reserve is very concerned that another year of inflation above the Fed's target, this would be the fifth year in a row, increases the risk that inflation expectations could become unanchored. Fed doesn't want inflation expectations to become unanchored. They hope they won't become unanchored. They're determined to prevent that from occurring, but they have to take that risk into consideration in terms of how they set monetary policy. One reason why the Federal Reserve will probably be fairly slow to cut rates over the next few months is because of concerns that if they make an error and it turns out that inflation expectations do become unanchored, that would make it much more difficult to get inflation back down to their 2% objective. So this is definitely a part and parcel of how the Federal Reserve thinks about it. You can see that in the summary of economic projections. In the back of the summary of projections, there's all sorts of charts on uncertainty. One thing that I like to look at when the Federal Reserve has their meeting and the press conference, I like to look at the summary of economic projections in the back to see how does the Fed assess uncertainty about inflation and employment. Has the level of uncertainty risen or fallen? How does the Fed see the risks of inflation and employment? Are they worried more about the upside risks or the downside risks to those two mandates? So the Fed does think about this a lot, and there is a lot of information available to figure out how the Fed's thinking about these things. Unfortunately, it just doesn't get the kind of attention as the median forecast that the Fed publishes in the summary of economic projections or the dot plot. And so I think, anything the Fed can do to sort of show that, there's a pretty wide range of outcomes. And this is one reason why scenario analysis, I think, would be very useful. By having different scenarios, the Fed could sort of explain to market participants and others that these are also possible outcomes. And most importantly, how would we likely behave if those outcomes were actually realized? The better that markets can think along with the Fed, the more effective monetary policy is. Because if the markets understand how the Fed's going to react to a new set of information, the markets can price it in today before the Federal Reserve actually acts. It makes the transmission of monetary policy to the real economy happen faster and more accurately. Carolyn, anything to add?
I think that another important aspect of the scenario analysis and the discussion about uncertainty is how those kinds of analyses can inform the actual discussions that the FOMC is having about the consequences of the more precise consequences of different forms of risk to the outlook and different possible scenarios. And of course, there's a communication aspect to it, but having those scenarios coming early to inform the decisions is pretty important to thinking about how to deal with uncertainty in different circumstances. It also forces the staff to think about their tools, because the starting point for some of the biggest uncertainty is related to the models themselves, and not all models are able to or up to the task to face the kinds of situations that we find ourselves in that just don't have an historical precedent, for example, like COVID. And so I think from a tools point of view and that development, just informing the discussions, that's something the Fed does, and I'm quite sure is investing heavily in, as are other central banks.
Thank you. We have a question from Mariam Tachanturia, economist at the National Bank of Georgia. How do you assess the current perspectives on the U.S. neutral interest rate? Moreover, how do you view the risks that a further rise in long-term government bond yields, driven by growing fiscal risks, could dampen the potential output and trigger concerns about fiscal sustainability? In this context, what kind of pressures could this situation place on the Fed?
Well, in terms of R-star, the short-term interest rate consistent with a neutral monetary policy, it's not knowable with any great precision, but you still have to have a view of it, because if you don't have a view of it, you can't really say whether you think monetary policy today is restrictive, neutral, or accommodative. I think the general consensus of economists prior to the recent changes in economic policy that the Trump administration has unleashed, the general view was that R-star had risen a bit. A few years ago, I think people thought R-star was around zero before 2% inflation, so 2% nominal federal fund rate. Now the Fed's median estimate of R-star is 1% plus 2% inflation, so 3% nominal federal fund rate. So the general view is that R-star is a little bit higher, but that could be changing as we speak. We're undertaking a pretty big regime change in terms of not just U.S. trade policy, but also policy with respect to immigration, deportation. We have a lot of uncertainty about fiscal policy. All those things are going to weigh on R-star. So I would not want to take the current estimates of R-star with any degree of confidence at this point. Carolyn?
Yeah, the second part of the question was really about the risk to the U.S. dollar sovereign debt markets, both short and longer term. I would say that there's two things there. It's impossible to make a prediction, and I'm not trying to do that. But certainly, if you back up, economists and market participants have been thinking about why are risk premiums so compressed for many, many years, including prior to COVID. And so the risk now is that those risk premiums are starting to increase, and maybe right now just going back more to normal. But there's a risk that those could blow out further, depending on how the economic outlook and global tensions evolve. It's something that, of course, the Fed and any central bank has to take into account when they're setting monetary policy, not only where the yield curve is, but how well the Treasury market, for example, is functioning. And so, because that's the main channel for the transmission of monetary policy, I would just say that that's not just an issue for the Federal Reserve. Given the importance of the US dollar market globally, it's an issue for every other central bank.
Thank you. We have time for this last question. Many central banks faced similar inflationary surprises in 2021-2022. What elements of the FAIT framework do you believe are inherently unsuitable for other advanced economies with similar dual mandates?
I mean, my sense is that most central banks don't have a dual mandate. They have an inflation target. Now, my personal opinion is that the two mandates are usually not in much tension, because basically, if I can keep the economy at full employment, I can probably also keep the economy at 2% inflation. Where the mandates become in conflict is when there's an economic shock that pushes you away from your objectives. But I think for most central banks, inflation is the primary goal. And I think even in the United States, if you don't have stable inflation, you're not going to probably have a healthy economy and a healthy labor market. So even in the U.S., I think the inflation mandate in some ways is in the first position, and the employment mandate is in the second position. And I think that's the way it should be. Carolyn?
Yeah, I think that even with countries that have single mandates focused on a particular inflation target, there is a regard for what's happening in the real economy. So employment, growth, and trade-offs are faced. It's just that the primary objective is inflation. Where I think the bigger difference is related to the asymmetry. So many central banks who have inflation targets as part of their framework, or the only part of their framework, have a symmetrical response to inflation below target versus inflation above target. And I think that is a distinguishing difference between the US framework as it stands today and the one that is the focus of a couple of our recommendations.
But we're highly confident that will be eliminated.
Thank you so much. Unfortunately, we've run out of time for more questions. We'd like to thank all of you for taking the time to join us today.